Welcome to the Independent Advisors Podcast, where we dive into the world of stocks, tradable markets, and financial planning with Jessup Wealth Management's Chief Investment Officer, Mark McEvely, and CEO, Matt Jessup. You'll hear tips, tricks, and strategies to address your financial well-being and, most importantly, conveyed in a way that everyone can understand. Here are your hosts, Mark and Matt.
Hey everyone, welcome to episode number 151 of the Independent Advisors Podcast, where Matt Jessup and I, Mark McEvely, bring you everything you need to know from the past week in the world of financial markets and financial planning. However, this week, Nick, our Director of Research and Trading here, is filling back in for Matt, who is out of the office today. So welcome back, Nicholas.
Good to be back, as always. I'm filling in again.
Yeah, it feels like you're starting to get more regular on this podcast.
I know. I'm getting called off the bench a little bit more.
You are.
It's nice.
You are. It's a good thing.
Getting a little bit more PT.
All right. Well, before we begin, as always, just want to take the first few minutes to recap the performance for the month and the year of the major indexes that we track. And these numbers are as of the market close on May 25th. And this data is from Koifin. S&P 500 index down 3.71% for the month and down 16.52% for the year. The Dow down 2.6% for the month and down 11.6% for the year. The NASDAQ Composite Index down 7.79% for the month and down almost 27% for the year. The IWM ETF that tracks the Russell 2000 Index down 3.36% for the month and down 19.65% for the year. Vanguard International ETF ex-United States down 0.76% for the month and down 12.78% for the year. The 3-month T-bill currently yielding 1.04%. 2-year Treasury yield sits at 2.43%. And the 10-year Treasury yield at 2.77%. Moving on to big headlines, current events from the week. I wanted to make a note on one of the things I talked about last week, Nick, and that was missing like the best 50 days of the S&P 500 return and what that would do to your overall returns over the long term. So we talked about, typically the S&P 500 has its best days when it's under the 200-day moving average, just because there's a lot of volatility to the upside and downside. But just another reason why people should stay at least somewhat invested, in my opinion, is you can miss some of the best days of the year and it can impact your return. So,
And good luck predicting those best days of the year.
Right, exactly. And this was from a blog post, Means to a Trend, written by Austin Harrison. And he said that $1 invested in the S&P 500 at its inception would be worth more than $200 today. If you missed the top 50 days, your $1 would have grown to only $4.40. Wow. So it looks a little extreme to me. Could be right. But I think people just get the picture of, if you miss some of the best days throughout every year, that it can impact your performance. So just another reason why we should have a process in place and not just completely sell and go 100% cash when we're in times like we are right now.
Exactly. Couldn't agree more.
Just wanted to point that out because I said I would follow up on that topic, but I will let you talk about ESG funds.
Yeah,
it's one of Jessup's favorite topics.
Yeah, so I was telling Jenna I'll have to be careful not to get on my soapbox here, because this is something that I can go on and on about. But there was an article in the Wall Street Journal. It was also on Bloomberg. I'm sure a couple other news sources picked it up, but it was titled, and this is from yesterday, it was titled, SEC to propose more disclosure requirements for ESG funds. And so I thought this was a great time to kind of give our listeners some background on the ESG industry and what this article is about, and kind of go through and take a bit of a detailed view. So quick background for listeners is at the role I was before Jessup Wealth Management, we used to consult on ESG quite a lot. Actually, we got a lot of questions, particularly when I was in the energy industry, right, from our clients. And based on this article, the industry, the investing landscape in ESG hasn't changed a whole lot. Back then, we used to describe it to our clients as the Wild West. It was there's no framework, there's really no rules, no not really any guidelines. And so I probably should have started at the forefront of this, but the people I was consulting with, and I've mentioned this before, were publicly traded stocks and their teams, and I was consulting them about their shareholders. So really had a deep understanding of how much ESG capital it is, and then what exactly investors had to do to be considered a socially responsible investor, an SRI fund. And really all these funds had to do was have some type of policy in place where they could check a box and say, yes, we look at this data. That's all they had to do, was just check that box. And so you could go to one of the major providers like a Sustainalytics or MSCI, which are big companies that are building the data set for all these ESG areas and data items that you can look at, carbon footprint, et cetera. Use of water is another example. And so all these funds would have to do is go and download a bunch of data from Sustainalytics, and they don't even have to look at it that hard. They can just download it, check, yes, that's part of our process, and now they're an SRI fund.
Right.
So this article kind of goes into a lot of those ideas and a little bit more detail. But what's going to happen is the SEC is proposing governing fund names a little bit more strictly, which is great. And then the other part is to increase disclosure requirements for these funds that are quote unquote ESG funds, which is a good thing for investors. This needs to happen because, again, like I said, it is a bit of the Wild West, and if there's no regulation, what you've had, and the article mentions this is greenwashing, where these big banks and these mutual fund companies will, they'll title themselves ESG, but again, there's no guideline, there's no framework, so they can mark up the expense because, it's ESG, it takes us more time, but all they have to do is download the data, and then they can pretty much run it like any other fund.
Right.
And then they charge the client more. So that's called greenwashing. So this will help with that. And I think the big picture here for investors is, we're still in the very early innings of ESG investing. And in my mind, it's kind of like where capitalism meets humanitarianism, right? It's that weird crossroads. And until there's a regulatory agency like the SEC that comes down, and then in tandem with these other data providers like Sustainalytics, like MSCI. Another one is Principle for Responsible Investing. It's unpri.org, right? So until those kind of regulatory agencies combine with these other data building agencies to create a framework, ESG investing is not going to change all that much, and it will be pretty minimal in the grand scope of things, as evidenced by the price action that we've seen this year with energy up and outperforming, right? I mean, if ESG investors were pushing the markets around, you have to imagine energy would be outperforming the way it is. So
right, exactly.
It's a good thing, this article, and a step towards that. And it's a good thing for the individual investor just to be more educated as to what exactly they're investing in, and to make sure that things like greenwashing don't happen. This is kind of
and I think it's important for this industry to be more transparent on exactly what ESG means for their company, right? So because that can mean so many different things, and it's just, to me, in the beginning, it was a kind of a marketing gimmick to be like, hey, we can charge higher fees. We're investing in socially responsible companies and that type of thing.
Which is harder because we have to look at more data.
Right. But if you really dig deep, Nick, I guarantee you can find something or hundreds of things at all these publicly traded companies that don't meet one or two of the ESG guidelines, right?
Yeah, absolutely.
So it's like, how far do you want to go? How far do you want to take this? And my opinion of the markets is that you shouldn't, and again, this might sound a little harsh, it's just my opinion. If you're in the markets for any other reason other than to make money, I feel like you're a little misguided, because that's what the markets are there for, right?
Yep, exactly.
And at what point do you walk that fine line of being like, hey, I care about, the environment. I care about companies being responsible. And I agree with that. That is 100%. I'm on board with that. But when that goes against your returns that you're saving towards retirement, like, where do you draw the line?
Yeah.
Right.
When it goes against your livelihood.
Right. Exactly.
Yeah.
So, do I know if energy is going to outperform over the next 5 years? No, I don't know. But if it does, I want to be involved in it. Right.
Exactly. Yeah.
So, just my 2 cents. I think obviously this is something that is not going away.
No,
and I think it's going to get more popular among investors, especially younger investors, because I think they have, a lot more, they care about this stuff a lot more than previous generations. So I think it's something that everybody needs to be paying attention to. But like you said, I think it's kind of the Wild West right now, and there's not really strict guidelines around it, which I'm sure we'll get there eventually. But again, if you look at any publicly traded company, and if you dig deep enough, you'll find something that doesn't meet the guidelines.
Exactly. And it will take so much time and effort to shift the landscape, because again, it's that crossroads of capitalism and humanitarianism, and the financial markets are, it's capitalism, right?
Right.
So it's going to take a lot to shift that.
Yeah.
A lot. I mean, it's going to take mass amounts of consumers wanting change, and like you said, like funneling their money differently, mass amounts. I mean, the majority of the market, regulation and more framework work between the issuers and the companies I previously mentioned. So
right.
Very early innings.
Yeah, exactly. And again, I want to make it crystal clear. I have no issues if a client comes to us and they're like, hey, I don't want to own firearm stocks. I don't want to own drug companies, that type of stuff. Right. So, and we can work around that, but it's just being transparent and honest with them and just saying that's completely fine. We won't do that. Or defense names is another big one. But at that point, we're limiting the pool of investments that we can select from. And typically when your investment flexibility isn't as great because you have certain limitations, in my opinion, that may open up the door to miss out on some good opportunities going forward in the future for good returns. And again, if it's one or two industries, not concerned about it. But the point I'm trying to make is if you get too constrictive, it's like, okay, like, what do we invest in here?
Yeah, exactly.
So,
and I want to jump in and also give a quick disclaimer that says, I believe in ESG and I think it's a good thing, and I'm happy that it is important. But the thing that kind of gets me going is what's happened with this greenwashing stuff, where you're misleading investors. That's where I feel passionate about it. It's good to see that we're collecting more data on climate change and how we can be better as a society.
Right.
But anyway,
cool.
I'll leave it there.
All right. So I'll jump back in. The first thing I had from tweets and research from the week was a blog post by Ryan Dietrich. And this was titled 6 Things to Know About Bear Markets. And this was on May 18th. So I thought this was fitting just given the environment that we're in. So I'm just going to talk about 3 of them. So his first note here was that there have been 17 bear or near bear markets since World War II. The average drop was nearly 30% and lasted nearly a full year. So again, just looking back at history, Nick, this is not an abnormal, what I would call bear market yet, right? We're actually below the historical average. Yeah. And typically these things play out over a year's time. So, we're, almost 6 months into the new year here. Some could argue that we're getting close to the end. Some say it's going to last for another year. No one knows at this point, but, the average drop is 30%. So the reason I bring this up is that, again, I know it feels way worse than it actually is right now, but we're not even at the average drawdown yet for a bear market. So I just wanted to throw that out there. The second point that I wanted to bring up that he made was that we've talked about in depth on this podcast before and through our newsletters, is that midterm years can be quite volatile, with the average year down 17.1% peak to trough. So a bear market during this year isn't out of the ordinary. Knowing that helps put this year's drop of 18.1% into perspective. The good news is, a year off those lows, the S&P 500 has gained 32% on average, something most investors would likely take right about now. So again, even though times are rough right now, we can see the light at the end of the tunnel, and that when we do get through this, I think you're going to see some pretty strong moves to the upside, and which is another reason why I don't like the idea right now of someone going to 100% cash, because I don't want them to miss that.
Exactly.
Last but not least, the S&P 500 is down 6 weeks in a row currently, the longest losing streak since 2011. It hasn't been down 7 in a row since 2001. What stands out about this data is if the 6-week losing streak is down more than 10%, like this one is, then the future returns can be quite strong, up a median of 9.9% 6 months later and 29.2% a year later. So again, when we have weakness in the markets, it just makes the forward returns of the S&P 500, for example, that much greater, right? So that was a nice post by our friend Ryan. The second thing I had was just dovetailing off of that, was a blog article by Peter Lazaroff. We've had him on the podcast before, and it was titled Comments on Bear Markets. So he kind of talked about some similar things that Ryan discussed. So I just want to go over some of the things here. The first thing he said was losses are completely normal. They're simply the price you pay in exchange for higher expected returns. The table below looks at intra-year declines, which are the red dots, and annual returns, which are the blue bars. And this data is tracking back to 1980. So he says drawdowns happen on an annual basis, averaging intra-year decline of 14%, and yet annual returns finished in the black in 32 out of 42 years. So I'll have Jenna put this up on the YouTube channel right now for everybody to see, but you can see, intra-year, how much was the market down from its peak and where it finished, right? Yep. So back it looks in like 1986 or 87, it was down 34% at the worst level, but it finished up 2% for the year, right? And the most recent version of this was COVID. It was down, 34% and finished up 16% for the year. So just because, again, and I've talked to clients about this in depth, just because it's been a weak start to the year does not mean that it would be out of the question to finish the year in the green for the markets in general. So again, drawdowns are a part of investing. And I know over the past couple of years, we haven't had very many drawdowns, so it feels different this time. But like Peter said, the average year sees a peak to trough decline of 14% at some point throughout the year. And right now,
I
think
the average spread.
Yeah, exactly.
Yeah.
And at the worst, the S&P 500 was down almost 20%. Now it's down like 16.5%. So pretty average so far, in my opinion.
And I would think that spread would be bigger based on this chart, but I guess.
Right. So so this is a really good chart. So Jenna will throw this up there. It'll also be on our show notes at Jessup Wealth Management on Twitter, at Jessup Wealth Management on LinkedIn and Facebook, and at Jessup Wealth on Twitter. But yeah, just a really good chart here by Peter to show that. The next chart that he shows that we'll throw up on the screen for everybody is the S&P 500 annualized total returns over rolling periods, right? So for an example, over a 15-year rolling period since the market's inception, there has not been one negative 15-year period. So the point I want to try to make here is the longer your time horizon is and the longer you're invested, if you do it for long enough, the periods of negative returns are literally zero, right? So in overall 10-year rolling periods, only 4.7% of those times there were negative returns. And then the closer you get, or the closer you bring the timeline down over 1 year, the range of annualized returns were from negative 43% to positive 54%. So the periods of negative returns were 26.3%. But just goes to show you again, the market goes up more than it goes down. We're going to have short periods where the market goes down, but if we're in it for the long run and you don't need this money for the next several years, let's let this thing recover, because we all know that markets go up more often than they go down.
Yeah, absolutely.
The last thing that I wanted to note from Peter was this. So he shows a chart of a history of bull and bear markets. And again, I'm putting Jenna to work here, but we'll throw this up on the screen, and this will be on our show notes as well. But it's a history of bull and bear markets all the way going back to January of 1926 to December of 2021. And I know you're looking at this right now, Nick. It's pretty astounding to see, how minor these bear markets look in comparison to the bull markets that we've had since 1926 up until now. Just shows very small, short periods of red declines as opposed to these massive bull market outperformances, and just, again, hammers that fact home that, yes, we're going to have bear markets from time to time, but if you give the market enough time to recover, it always has in the past and has gone on to make new highs. So, he ends the article off with this. It's periods like these where the market requires you to embrace fear and uncertainty in exchange for the returns you need to compound your wealth over time. Unless you need your entire portfolio to meet living expenses in the next year, the benefit of missing some of the downside is far less impactful than ensuring you capture the upside whenever it comes.
Yeah.
So again, and we talked about this a little bit last week, for anyone that has money invested that they need within the next year, I personally think that money should be in cash, because you need that money in 12 months or less than 12 months. That should be in cash, so there's no risk that it's gone by the time you need it, right? But people didn't want to hear that during the raging bull market that we had in 2020 after the pandemic, right? They're like, where should I put my money that I need for a down payment on a house in 6 months? And my response was always like, it's tempting to invest that, but I would feel more comfortable if you have that money in cash ready to go when you need it, because I don't ever want someone to be in a situation where they had the money and, the market fell by 20 or 25%. Now you don't have it anymore.
I'm chuckling because you said the same exact thing when I started here, and I said, "Do you think I could get away with something like putting it in the market,
right?
Maybe make a little money?" And
yeah,
you
exactly.
Said, just keep it in cash.
Just keep it in cash.
So, I thought about doing the same thing. It's tempting, but it's a good point.
Yep. So the last thing was another article by Ben Carlson that's comments on bear markets. So I don't mean to be too negative this week, but it's just a common theme that I was seeing, and we're right in the heart of it right now. So I thought it'd be good to share. So again, from blog post, A Wealth of Common Sense by Ben Carlson on May 15th. He said, bonds are supposed to be the stabilizer, the flight to safety, the anchor in the portfolio when stocks fall. It's not normal for both stocks and bonds to go down at the same time. In fact, my research shows there have only ever been 4 years since 1928 when both U.S. stocks and U.S. bonds finished the same year in negative territory. And for U.S. stocks, he was using the S&P 500. For U.S. bonds, he was using the 10-year treasuries. And those years were 1931, 1941, 1969, and 2018. The worst year for bonds in these 4 years was a loss of just 5%. Right now, U.S. stocks are down more than 15% on the year, while bonds are down more than 10%. Does this mean diversification is broken, or is it possible this is just a bizarre market environment because a pandemic sent interest rates crashing to the lowest levels in history, and now they're normalizing? I tend to think that it's the latter. So I actually agree with Ben here. I think what you're going to see, Nick, is people are going to think that bonds are done being the safety net of portfolios, and people aren't going to want to invest in bonds anymore during rough times. And I think that's going to be a detriment, I think, over the next several years or the next couple of decades. It's just because we had this one event where bonds didn't act the way they should have, there are a lot other factors. And again, this quote unquote bizarre environment that we're in, that we haven't seen a lot of times that stocks and bonds were down at the same time. But we also really haven't seen an environment where, the Fed is trying to raise interest rates so quickly to battle inflation right now. And we all know that bonds and interest rates have an inverse relationship, right? So, there's been a lot of talk about the 60-40 portfolio and if it's dead or if it's going to continue to work. I don't think it's dead. It's just not working right now.
Right.
Will it work in the future? I think it probably will, because it's going to be a different reason why markets are falling, different reason why investors are concerned. So I don't think it's necessarily the right time to completely write bonds off. And I just fear that, when we go through another rough time in the market after we recover, people are going to remember this and be like, no, I don't want bonds. I just want it to all go to cash. And I think, just because bonds haven't worked this one time doesn't necessarily mean they're not going to work in the future.
It's an anomaly, right? And it's a very weird bond environment. And I listen to bond experts, guys, fixed income traders on Bloomberg and the morning shows that I watch and whatnot. And a lot of the bond guys, they talk about the normalization of the bond market and how it's not really a normal bond market right now because the Fed has their hands all over it. I mean, if you pump all this money into any kind of market, you're kind of changing the freedom of the market in a way, right? So of course prices are going to act weird, right? I mean, if you have one investor, which is, in this case scenario, kind of what it is, dominating the market for a couple year period, it's going to change the market dynamic. So the historic low interest rates, like Ben mentioned, and you take that and combine with the Fed balance sheet, and it is unprecedented. So I think things will return to normal.
I think they will eventually. It's just going to take time.
Yeah, it's a good one. Let's see. Speaking of the Fed, this takes us right into it. So the first thing I have is a chart for listeners from Compound Advisors and our good friend Charlie Bolello. It's a research note from 517, and it's about the Fed being behind the inflation curve. And it's a chart here that shows U.S. CPI year over year with the Fed funds rate next to it. And it's a good chart because I think it provides some historical context as to just how aggressive the Fed has to be, which is one of the reasons why the market is so angsty and selling off so aggressively, right? This chart kind of says it all and is a great follow-up to what you were talking about with the bear markets. Charlie says this: the Fed has now hiked rates 0.75%, but they remain far behind the inflation curve, with the gap between CPI and the Fed funds rate at its widest level since 1974. In 1974, the Fed funds rate peaked at close to 13%. Today, it's still at 1%.
Right.
So that's, going back to what Ben Carlson just said, historically low interest rates. And again, in this environment, it's pretty drastic, which is why the bond market is acting weird and stocks are underperforming. I mean, it makes sense, right?
Yeah, it does. And I think you can clearly show, and we'll have Jenna put this on the YouTube video as well, but I mean, you can clearly see here that the Fed is indeed behind the curve. And, everyone's like, well, why is the Fed being so aggressive? And this chart explains that.
Yeah, they have to. They're
no
backed into a corner.
No one wants higher prices. And like we talked about, I think, people hate inflation more than anything else, and especially at the pump. And the Fed is trying to counteract that, but people are just worried that they're too far behind. And by the time they raise interest rates to catch up, that it's going to be time to cut rates again, right?
And they're going to shock the economy.
I think the fear is we're going to be in this never-ending cycle of raising interest rates and lowering interest rates, right?
Yeah.
So, it's a great chart.
Yeah, and when if any listeners are out there and they're thinking, well, gee, how could the Fed miss this? I mean, just look at the chart. What were they doing? I'll take you back to the famed word of transitory. If you guys remember, 6 months ago, a year ago, probably closer to a year at this point.
Mm-hmm.
And after COVID, when we had that big V recovery in the stock market, inflation started taking off, and the idea that was being tossed around by all these economists was that this inflation was transitory, and it was just a reaction of those massive spikes we saw across the entire globe, but the financial system, cash, of the personal consumer, supply chains, et cetera. And they thought inflation was going to come down, and it obviously didn't. So that's why they're late to the party. So
right, exactly.
Quick reminder to listeners on that.
Yeah, absolutely. And I thought it was going to be more shorter lived as well. But it just goes to show you, this is why I don't like predictions. Yeah. Because even the Fed, the chairman of the Fed, thought it was going to be transitory, and it wasn't. And who's more qualified to have an opinion on that than anybody else in this country?
Yeah, exactly.
Right. So that's why I don't like putting, predictions out there on what is the market going to do over the next 6 months. No one has any idea. Yeah. I don't have any idea. You don't have any idea. Jenna doesn't have any idea. The Fed chair doesn't have any idea,
clearly.
Right? So I just want to throw that out there, that is a reason why I do not like that stuff.
Yeah,
so.
Exactly. And that's not to throw any shade at the Federal Reserve or Chairman Powell or anything. These economists, they're brilliant. They're brilliant guys.
Mm-hmm.
Sometimes they get it wrong.
But we're human.
Gals.
Yeah.
Sometimes these brilliant economists get it wrong. It's all right. The next thing I have is an update on the personal savings rate. This is also from Compound Advisors. And it's a chart on U.S. personal savings rate percentage. And it's a good one. It shows the first stimulus check, the second stimulus check, and the third one. And then it shows where we are now, which, the chart says it's at the lowest level since 2013. Yes, technically that's true. But the way I look at this chart is, okay, we're back in a normal range from that personal savings rate we saw in the pandemic. But the comment that Charlie made was this: how is U.S. consumer spending still so strong despite inflation outpacing wage gains for 13 straight months? Americans are saving less, and the savings rates moving down to 6.2 is its lowest level since 2013. So his idea is, I guess, signaling concern about, the savings rates back down, but we're still seeing retail spending at a pretty strong level. At what point do we see that start to fall off, right? And that's, just another kind of negative indicator that people are watching in the stock market, which is why the price action
right, exactly, right? And that's how these economic cycles work, Nick, right?
Yep.
So you have a bunch of demand for a bunch of products, and especially with supply chain issues, we don't have that much product right now. Prices are going to go up. So how do we get those prices to come down? Consumer demand comes down, right? And this is one of the charts, and one of the indicators to me is that consumer demand is going to come down over the next 6 months or 1 year, just because people don't have as much cash right now, right? Yep. So this is just a normal part of the economic cycle that we're in the middle of. We haven't been at this point in it in some time, but it is normal, and it is playing out how I would expect it to play out.
Yep. It sure is, which leads me into my third and final piece of research here. And I promise I didn't intentionally theme all of this stuff, but it's really fitting together well here. It's a tweet from Steven Straza. Yeah, he's the director of research at All Start Charts, and it's a chart of the consumer discretionary versus the S&P 500. And the line he said in his tweet was this: discretionary stocks entering a bear market on a relative terms was a pretty good leading signal during the last two crashes, where we are there now. And it shows, as these consumer discretionary charts turn over, as this retail spending, this idea that, once the consumer starts to slow down, obviously you're going to see your consumer discretionary stocks come down. That's natural. It's a leading indicator. But the point he makes is that, once that level hits, oftentimes in the past two major crises, the dot-com bubble crash and the great financial crisis, that was just the beginning, and the market went a lot lower. And that's not, that's not to say that I'm taking this chart at 100%. It could go higher from here, but it's an interesting point just to remind people that, like you mentioned in your research notes, these bear markets can be drawn out, and you can have bear market rallies, as Matt has talked about in the past couple podcasts. But we still could go lower from here. That's not out of the realm of possibility.
Right, exactly. Yeah, and Jenna will put this on the screen as well for everybody to see, because this is a pretty good one. And when we say consumer discretionary relative to the S&P, it's plotting the discretionary sector versus the S&P 500. So every time the consumer discretionary sector has been underperforming by 20% from its peak. And this is that indicator that Stephen is showing right here. But it makes sense, right? Because people can go without discretionary items, right? Yep. But they can't go without the staples, right? So obviously people need food to live. They need water to survive. They're going to continue to be buying their hair products and their toothpaste and that type of stuff, right?
Yep.
But people aren't going to be hog wild spending on Amazon as much anymore, or, they might not be able to afford a Tesla, right? Yeah. It's like that discretionary stuff. Those are two names just as an example that are in the discretionary sector, a lot of the retail names, right? So, again, something that makes sense to me with the savings rate coming back down to normal, with the inflation that we're seeing right now, it makes sense that discretionary stocks are getting hit because of where we are in this economic cycle.
Okay? Absolutely.
I'll take it over from here, Nick, and talk about our financial planning topic of the week. This was an article from Plan Corp, and this was back in actually July of 2020, titled "The Untold Advantages of Your Employee Stock Purchase Plan." So something I don't think we've really talked about a lot here before is that a lot of these publicly traded companies, Nick, they have an employee stock purchase plan where their employees can either, one, buy stock in the company at a discount via weekly payroll deductions, or they can buy up to a certain amount of stock every single week or every pay period at no discount. And I think this is one of the most underutilized benefits at these companies, just because I've worked with publicly traded companies that have this option, and just from seeing it, a lot of people don't utilize it. So my goal of this is to kind of break down how these stock purchase plans work and give people an idea of what they could be useful for. Okay. So an ESPP, so also known as an employee stock purchase plan, is a valuable benefit offered by some publicly traded companies. It allows employees to purchase company shares at a discount, often at 5% to 15% of the fair market value. How does an ESPP work? There will be maximums associated with how much stock you'll be able to buy per pay period, since your company automatically funds it directly from your paycheck. Given what a good deal an ESPP can be, it's not surprising there are limits on how much you can contribute. The IRS currently sets a pre-discount upper limit of $25,000 per calendar year. So for employee stock purchase plans with a 10% discount, meaning that employees can buy the stock for 10% cheaper than what it's trading at, the most you can purchase each calendar year is $22,500. And that's obviously just 25 grand minus 2,500. So if you don't have a discount plan through your employee stock purchase plan, and you can just buy stock via weekly payroll deductions, the most amount you can buy every year is $25,000. But in addition to the IRS restrictions, companies often further restrict contributions. The cap varies, but often ranges from 10 to 20% of your salary. Your company can also place a dollar limit on the contribution below the IRS limit. Also take note that the percentage of income you elect to contribute is based on your pre-tax salary, not your take-home pay. That means a 10% election will decrease your take-home paycheck by more than 10% after all tax withholdings and various deductions. If you find yourself cash strapped and you over contribute to an ESPP, you can sell some shares as soon as they are purchased to generate extra income. However, it is important to understand the tax ramifications of selling ESPP shares. In fact, ESPP tax planning deserves a conversation of its own. And just to keep this at a very high level, Nick, and not go into it too much, there's two different positions in an employee stock purchase plan. One's a disqualifying position and one's a qualifying position. So a disqualifying position is when you hold your shares of your company for less than 12 months. All of that, including the gain off of the discount you got on the fair market value, is taxed at your ordinary income, right? So there's an incentive there to hold these shares for longer than 12 months. Just opposite of that, a qualifying position is when you have shares that are held for at least 1 year after the purchase date. Those gains are taxed at your ordinary income tax rate. However, the company discount is always taxed at your ordinary income level, okay? So when you're buying shares at a discount, whatever that discount is, that's going to be taxed at ordinary income when you sell your shares, okay? Getting to the meat and potatoes of this is what I wanted to talk about, is using the ESPP to fund your financial goals. So, one of the things that we talk about when we talk with employees of publicly traded companies, Nick, is, if you're saving for a down payment on a home, or you're saving for a new car, or even if you're just trying to save to build up your emergency fund to 3 to 6 months living expenses, why not do that and get a discount in buying your own company's stock to where you can go ahead and sell that and fund your down payment on your home, a new vacation home, a new car, rather than taking out a loan for 5, 6, 7% and eventually paying more than what you need, right?
Yeah.
So this is just a way for someone to save for near-term goals. And what else that I've seen from publicly traded companies, if they don't offer for their employees to buy shares at a discount, they'll do like a match, kind of like a 401k. So, people can contribute up to $400 per pay period of their pay to buy company stock, and that company will match them up to 5% or 10% of whatever they're contributing. And at that point, that's just free money, that if you're not taking advantage of that and maximizing that out, you're just missing out on free money, because you can turn around and sell that stock right away and move it to your bank account and just take the match, whatever the company gave you, and you have automatically 5 or 10%, whatever the match is, more than if you're just saving money every month directly from your paycheck into your savings account. Right. So it's giving you that extra bump to get to those goals quicker. So Peter kind of notes, three different ways to use ESPPs in retirement planning and financial planning. Number one is supplementing your cash flow. And he says when you first enroll in an ESPP, it may hurt to see that chunk of change coming out of your paycheck, but if properly managed, you can ultimately end up with more after-tax pay compared to not participating. Number two is saving for near-term goals, kind of what we just talked about. So they can help quickly fund near-term goals like buying a home in the next year or two. And he says, even after tax, your rate of return from selling vested ESPP shares as soon as you receive them should be many times higher than today's highest yielding savings account. It's like adding a Powerball to your savings every time a new batch of stocks vest in your account. Number three is investing towards long-term goals. ESPPs can also help you reach longer-term goals such as retirement. Whether you hold company shares as a small part of your portfolio or diversify them periodically, the compounding of ESPP can add up quickly. For example, if Alex consistently contributed $450 every paycheck for 10 years, that could add up to as much as $200,000 pre-tax. So again, these employee stock purchase plans are another really good way so that you can even use it as like an emergency fund. So if you needed money, you could sell the shares and take that money and do whatever you need to do with it. But it's a really good way for people not to have to take out debt, like personal loans or even worse, 401k loans. Yeah. Because that's what I've seen. Most employers offer the ability to take 401k loans, and I wish they didn't.
Yeah,
because
mine did.
You take that money out, and it's losing the magic of compounding. It's not in there and growing there for you. Another sticking point for me as to not take 401k loans is if you take your 401k loan, you're repaying that, right? And even though you're paying, quote unquote, yourself back, if you're repaying that loan, you're probably not contributing as much as you were to your 401k. And if you aren't contributing as much as you were to your 401k pre-tax, that's artificially raising your taxable income because you get to deduct your pre-tax contributions to your 401k off of your tax return, right? So there's a lot of different intricacies with taking 401k loans. And this is why if people have stock purchase plans, I so highly recommend it to just completely avoid ever taking a 401k loan because it is a massive difference in the ending value of your 401k if you take loans throughout your career.
Yeah, that's a big deal. Yeah. Well, try to avoid it if you can.
Yeah, exactly. So I didn't mean to get on a rant there, but definitely one of my passions is going through and helping people with their employee benefits plans. And this is just one of the things that I see that is available to a lot of people that work for publicly traded companies, but it's not necessarily utilized as much as it should be. And we're all about here, during the good times, prepare for the bad times, right? We go through cycles in the economy, so let's build up this company stock that you have so that when we enter into a recession, which inevitably we're going to be in eventually, we have a pool of money that we can access to get you through those tough times.
Yep.
Right?
Yeah, love it.
So I think that's all I had this week. Nick, anything else you want to leave listeners with before we wrap up for the week?
No, that's everything for me. Thanks for having me again.
Yeah, absolutely. So we're going to be heading into the month of June, almost going to be halfway through the year here in another month or so. Again, just want to leave listeners with, I would anticipate more volatility over the near term. Typically in midterm election years, markets tend to start to creep up towards the end of summer, early fall. And then usually in midterm election years, most of the year's return comes in Q4.
Yep.
So again, not abnormal for us to see this right now. A lot of other noise out there, but we will get through this, have a long time horizon. It's part of the things we have to go through as investors in the markets. So we'll get through it, but we will be back with you next week for episode number 152. Hope you all have a great long Memorial Day weekend, and just like to thank everybody who has served our country. We wouldn't have the freedoms today that we would if it weren't for them and the sacrifices that them and their family has made. So
yeah, that's right.
Thank you to everybody who has served, and let's celebrate them, and everybody have a great weekend.
Thank you for listening to the Independent Advisors Podcast. If you're interested in hearing more, hit the subscribe button so you can be notified every time a new episode gets released. Feel free to share with friends, family, and follow us on Twitter at Jessup Wealth, Facebook, and LinkedIn. Mark and Matt will continue to share beneficial information on these social media sites. Also, check out the podcast tab on their website. That's www.jessupwealthmanagement.com. There you'll find links to every episode of the Independent Advisors. Have questions or topics you want to discuss on the show? Message us on Twitter, LinkedIn, or send an email with the words questions and topics in the subject line to inquiries@jessupwealthmanagement.com. We'll talk about it right here on the podcast. Certain sections of this commentary may contain forward-looking statements based on reasonable expectations, estimates, projections, and assumptions. Forward-looking statements are not guarantees of future performance and involve certain risks and uncertainties which are difficult to predict. All indices are unmanaged and are not available for direct investment by the public. Past performance is not indicative of future results. This podcast is provided for general informational purposes only and does not constitute either tax, legal, or financial advice. Although we do go to great lengths to make sure our information is accurate and useful, we recommend you consult a tax preparer, professional tax advisor, financial advisor, or lawyer regarding your specific circumstances. Investing involves risk, including the loss of principal. No strategy can guarantee any objective or goal will be achieved. Advisory services offered through Commonwealth Financial Network, a registered investment advisor.